Hello, and thank you for joining me once again. Today I have the distinct pleasure of being joined by Mark Tomaino, who is an operating partner with Welsh Carson. For those of you familiar, you know Welsh Carson is one of the biggest private equity firms in the world in healthcare. So Mark, thank you for joining us.
Thanks, Phil. It's good to be with you.
Mark, I know that you have a lot of experience in this field, and I would like to ask you, if there is a company that is contemplating a transaction with private equity, what sort of advice would you give that company, given the current coronavirus situation?
The advice probably would apply pre-pandemic and post-pandemic, and a lot of companies engaging with private equity have experienced private equity due diligence. My advice would be to do your own due diligence on your prospective partner. There are so many private equity firms in the world today, and it's a relatively new asset class when you consider the fact that 40 years ago when we were founded, we were one of a handful of firms, and now there are thousands, which means there are hundreds of millions and billions. I think the latest estimate of dry powder was in the trillions of private equity capital, which means that firms come in all different shapes and sizes and cultures. And I think any company looking to raise money owes it to themselves to understand who their prospective partner is in good times and bad. The saying is that when companies are doing well, private equity professionals have quite an easy job. When things aren't going so well, that's the true test of your partner. And so I think it behooves any company to get to know the people who are going to be sitting in the boardroom and to engage in a discussion as to how things will be when the unforeseen happens, or even when the foreseen happens, but it wasn't for lack of good execution. Sometimes the world just changes, as we all have experienced over the last few months.
When I think about all of the people who write to you every day offering their services, I completely understand the importance of evaluating your partner. What are some mistakes that you think companies make when selecting their private equity financing partner?
Well, one of the byproducts of having so many firms out there is there's a lot of capital chasing too few deals. And when I say too few deals, I mean high quality businesses that are addressing real problems that will be persistent, which leads to some companies really focusing on the headline valuation number, that is maximizing value today, versus thinking about what a new private equity partner, new capital, growth equity, which is where I spend my time, can create in terms of future enterprise value. And oftentimes the risk you run as a company in trying to maximize the current equity valuation is some of the more knowledgeable, disciplined private equity firms will actually not get there because they know how hard it is. And some of the less experienced who want to have allocations into healthcare, for example, will pay too high a price, which ultimately will come back, particularly when you're doing something less than a full buyout, will come back to create misalignment between the investor and the management team. So my advice in that regard would be reasonable in terms of current valuation, focus on the larger valuation creation opportunities, and really focus in on how will the capital be used. Do your partners really understand the constellation of opportunities to go after together? And at the end of the day, it's really about kind of making sure that you're all dancing to the same musical beat, if you will. And I've seen too often that getting valuation wrong is the quickest way to destroy value for an investor, and getting valuation right is kind of the mortar that can create a real team between an investor and a management team.
You know, that makes me think of sort of a related question. What are the drivers, what are the most important drivers for creating value in a company, you think?
Yeah, well, in my experience, you know, the first probably two key things that are foundational is you got to have, you know, an attractive addressable market. So a larger market, a growing market, kind of table stakes. And then secondly, you need to have some really good kind of macro or secular drivers, demand drivers. We call them tailwinds versus headwinds. But when you have a large addressable market, you have some strong demand drivers and secular tailwinds and a very good management team, then you can start looking, you know, internally at the profile or the attributes of a company that over time will help you increase valuation. One of them is revenue complexion. Having a large percentage of recurring revenue is obviously very attractive. It creates visibility. It eliminates the possibility of volatility. Number two is, and these are basic things, but sometimes there's nothing common about common sense, a very attractive margin profile. So high gross margins, better than low gross margins. High gross margins would seem to imply pricing power, or at least the ability to withstand pricing pressure. And then obviously if your EBITDA margins are expanding at a faster rate than your revenues are, that suggests a high degree of operating leverage, the ability to really create more value for every new dollar of revenue because you're dropping more down to the bottom line. And then of course, capital efficiency. This is where good management teams come into play, is that, you know, oftentimes if you think about the basic equation of creating value, it's a multiple, usually a multiple of EBITDA, sometimes a multiple of revenue. But what a lot of folks don't think about is when you're spending dollars, you're effectively reducing EBITDA as compared to if you didn't spend that dollar. But when you spend that dollar, you're really making a value creation or value destruction decision. So for example, if I'm trading or if I'm valued at 10 times my EBITDA, if I'm spending $1 of EBITDA, then I'm really making a decision that I'm going to take $10 of value and I'm going to spend that dollar to create something more than $10. But if I don't spend that dollar judiciously and thoughtfully, it could very well be that I haven't created value at all. Good disciplined management teams go through that calculus when they spend money.
Well, that is really interesting. It's a mouthful. And of course, I'm going to write in my diary tonight that common sense is not that common. So, Mark, you know, it's wonderful for you to join us here. And I'm sure that the average person is going to have to listen to this twice. But there's a lot there. And I really appreciate you spending time with us today.